start our fireside chat. So first of all, while he is fixing some technical problems over here, I would like to welcome you to the fireside chat. The conversation topic is going to be the future of digital lending in Africa. The concepts that we want to touch is basically sitting on 6 different pillars, and I think there's a logical sequence to the topics that we're going to talk about. We will start with the concept of data. You know, data is becoming more and more available, and there's more of it. But what do we do with that? After talking about the data, the next subject is going to be analytics. You know, how do you extract insights and actionable information out of that one? After talking about the analytics, technology is the natural next step. And when you talk about technology, there is some counter forces that work with that one, which is the cybercrime that we will touch, you know, fraud and ID type of issues and solutions. We will follow up with some governance discussion related to scoring and related to other topics. And then the final point is going to be, which is going to be a surprise for everyone, but at the end of the day, all these pillars that I've spoken to you about, it is all around the end customer. So the evolution of digital lending in Africa, where is it heading to, and how are we impacting the individuals, the people basically at the center of this whole process. Fairly casual conversation this will be. There's no question about that one. Feel free to ask questions. If anything is not clear, if you have a point to make, or if you get a question, please raise your hand. I actually have a co-host with me. Karen is sitting over there. You know, Karen and I have a pretty, you will notice it basically 15 minutes into the conversation. We're a direct relationship on the business side. She will probably, you know, set me straight if I miss anything, or if I daze, or if I start repeating myself, you know, she'll make sure that I rectify the situation. So without further ado, I'll turn it over to Kamau, who does the introductions.
Good evening, everyone. Welcome once again to the Credit Info Fireside Chat. We seem a bit spaced out. Can I please ask, maybe you can huddle up together, and the closer we are together, and keep warm in this South African beautiful cold. But welcome, as Burak said. The idea is to have a riveting conversation about digital credit in Africa. Africa is such a huge continent, and there are different dynamics that we see across the continent. In Southern Africa, it might not be as big as we are seeing it in other areas in Sub-Saharan Africa. So I'm sure we're going to get quite a bit of insights from the panelists who are here, from a diverse range of different industries, all connected within the whole digital ecosystem environment. So I'll start with the ladies first. Lucy Kiai. Lucy is with Safaricom. I wouldn't say too much because I want her to actually talk more about what it is that she does. But as a brief, you know, kind of introduction, Safaricom is a telco in Kenya, and they started M-Pesa, which is a mobile money transfer business, which is now well renowned for the numbers that they've been able to push out there, now not only in Kenya, but in 10 different markets across Africa. But been a great success in Kenya in the work that they've been doing. And I'm sure she will talk more about how they use credit as a part of their financial inclusion strategy in the work that she does on a day-to-day basis. And then we've got Jashan. Jashan will give us the other side of things that's a bit different from Safaricom side. Jashan is with FICO. He's also very well experienced in the risk management and credit scoring area. Before FICO, he's been with TransUnion and other. I mean, he'll get into that. I don't want to give too much about the panelists. They'll get a chance to speak more about what they do and where they are. But he's going to give us that aspect about what is it from a risk perspective, how is digital, what are the challenges, what are the difficulties that they see in it, and how are they able to scale the business for those that are getting into that digital space. And then last but not least, we've got Philip, who's with East Africa's largest bank, Kenya Commercial Bank. He will tell us about what, and remember, this is the interesting thing, you've got a telco here that is consumer-centric. They want every customer to have everything that they offer. And at the far end, you've got a bank that's risk-averse, that's always trying to measure the risk that they're giving out to their customers. So I'm sure it's going to be a riveting conversation on how that balance is actually created in terms of the partnerships that they've been able to create between telco, bank, in this digital regime that we're seeing coming across in Africa. So please, also as we have this discussion, it's not just for them, it's also for you to also contribute, to engage and interact with the panel that's up here. There is no right answer, there's just opinions and exchange of ideas and thoughts to be able to get better insights and better understanding, or just a good knowledge exchange for all of us, and appreciate today's evening from the panelists and yourselves as we discuss. So please, welcome and let's engage. Thank you very much.
And don't forget, tweet at #CreditInfoFireSideChat.
Correct, yeah.
Thank you, Kamau. While I have this opportunity, let me tell you a story about Kamau and the East African team, actually. Let me start that way. Kamau was talking about cold weather, basically. I personally am enjoying it over here, but I have a way of, through our conversations with Kamau, exactly telling what the temperature is in Kenya and in East Africa. In video conferences or face-to-face, if you see Kamau in a coat, proper coat, you can pinpoint that it's 18 degrees outside. If Kamau is wearing, you know, one of those gilet things in French, you know, the ones that without have the sleeve, the puffy coats, then it's 20 degrees. And if Kamau has only a shirt, proper shirt, then it's about 23, 24 degrees, basically. You might be asking me, what about the extremities? You know, what if it's 15 degrees or something like that? I have never seen him step outside his house, basically, at that temperature. So I'm sure I'll be hearing about that one in the next fireside chat, but I mean, come on, there you go. I start the game 1-0. Going back to what we're going to talk about, some rules about, you know, where the restrooms are. You're going to find them to your right over there. The drinks and the food is behind you, but I don't see much left over there from neither of them. And if there's any kind of a fire, natural disaster or something like that, given we're outside, run into any random direction, basically. You should be okay on that side. So that's you know, the ground rules. As far as questions and answers sessions, I think please do apply your common sense. You know, if you got a question, try to be succinct as much as possible, of course, given the background. Do not be shy about, you know, should I be asking that question or something like that, go for it. I think I made that point at lunchtime, but please consider this simple fact. Over here, there's more than 50 years of experience, you know, when look at your panelists. The concept we're going to talk about started in early 2000s, so give or take, it's basically 15 years. I think we have a pretty good coverage over here to talk about subject and give you, you know, their experiences and the direction where the digital lending is going. So that's one thing I wanted to talk about. I talked to you about the 6 pillars, basically, you know, the data evolution all the way to the governance and so on and so forth. Just a little bit of a background. The whole concept started in early 2000s, I said. Yes, it did. It was a very simple concept, but it was an extremely effective concept, M-Pesa. And it was targeting, you know, the financially non-existing people. You know, it was going after basically these people, and it was a very successful concept. Then it evolved into a whole infrastructure, basically. Because of the simplicity and because of this efficiency, what kind of an impact, you know, this concept, the digital banking, digital loans, did it have on the economy? If you were to look at sub-Saharan economy, basically, between 2013 and 2022, the evolution on GDP, the impact of digital money, digitalization concept is approximately 3.7% growth on GDP. $150 billion is what we're talking about. That's quite substantial. That's not only substantial, and the adjectives I'm going to be using, I wrote down because, you know, those are the things that should be spoken about and talked about. I mentioned simplicity. There's also efficiency of the process, but there's also the inclusion aspect of that one, the versatility, the transformation is another word that comes to mind, and ultimately, it keeps a promise to a large group of people, millions of people, basically. That's what this is a very important concept. And that's why, you know, the topics our panelists are going to be talking about, how has it evolved, but how does it look like in the future is very important. And most of the time, both Kamau and I, we talked about East Africa. There is the West African side of that one as well. In West Africa, there's organizations right now that are going into digital lending processes In Ivory Coast, Cote d'Ivoire only, there is a little over 2.4 million loans that's granted, and the concept is new, as I indicated. So imagine the speed that they're working at. Imagine the learnings they're applying to the West African universe, basically, from East Africa. So the concept is not just local, the concept is all across Africa, basically. And it's very, very powerful. A couple of examples, the loans that we're talking about in West Africa is what they call the nano loans, from $8 all the way to $1,000 is the size. Largely, if you were to look at the averages, it's in the vicinity of $50 basically. What is the target population? Average age is 30 years old. Average loan term is approximately 30 days basically. And these people, they tend to live in metro areas, but the loans, the target audience is going more and more into rural areas. Again, it's the efficiency and it's the success of the concept of digital lending. So I'll leave the introduction at that point. I'll go back to the very pillars that I have mentioned to you, and I will turn to our panel over here and start with the data concept. What are your thoughts on open banking, and what do you think potentially in the future is going to be the impact of open banking on digital lending? And as far as the panelists go, feel free to jump in. At this point, I don't want to pick individuals over here, so go ahead.
Thanks, Burak. I'll take this one initially because I'm in very good company, having a telco and a major bank here. So I think this is a very interesting question because it poses two distinguishing views, right? And in markets where you do have open banking, the benefits need to be sort of discussed at length to get to a point where you actually find what's mutually beneficial for all the parties, right? So on the one angle, obviously digital lending, the ability to consume a lot more data, utilizing that data and processing it at rates where traditional large banks can't do it, obviously has major benefits. You can untap a larger part of the population, treat the underserved and unserved markets more. So definitely positives in terms of utilizing what you may get from open banking data. But then on the other hand, where you have a large bank who's managed to get some sort of transactional relationship with a client, which taken many years and has that information, they may not be able to process that data as rapidly as maybe a digital lending organization. But that data is what they have on that customer. Exposing that data then may also lead that customer away from them into something that's more convenient and more accessible from a digital lender. So exposing that data doesn't leave a lot of benefits to the major banking, and I'm very happy to hear Philip's thoughts on that. But how do we find that balance? What I believe kind of that balance sort of lies somewhere between that social interaction of driving financial inclusion and education, and that can be done through partnerships together. But that might also be very careful to sort of decide what type of population and which part of the market you actually go into. I'm happy to leave it there, just maybe hear the different interpretations. My colleagues here.
Understood, and I think that goes towards a point that I wanted to make. With open banking, there's usually the clear assumption that banks generally would not be full support. But I think with the we're talking about the future of digital lending, and with the recent developments, I think it's up to banks to quickly determine exactly how they can benefit from these arrangements. Because look, you have banks who have probably the largest set of real credit history, real transactional data. How do you position yourself in a market where open banking comes in so that you still reap benefits? You have this customer, he's got your mortgage, probably your more formal digital lending product, of course running transactional accounts, credit cards, and so on. I think it's up to banks to try and figure out, how can I live within that open banking environment? Is there a chance that I can thrive? Can I continue to offer my mortgages, my credit cards, current account overdrafts, and everything else, formal digital lending loans, but make space? Have that open banking channel help others get a clear or a complete credit profile of customers, and offer what I can't without losing the customer. Using our main market, Kenya, for example, there's quite a bit of regulation as far as banks are concerned. How much you can price, what kind of loans you can get into, as long as you're putting custom deposits at risk. But non-bank digital lenders can lend beyond that because they're not probably not as tightly regulated. So there's a chance that you can, through open banking, expose your customer to these products while retaining them for regular banking products. So I think it can still end up being a win-win banks and others within an open banking environment.
I totally agree with my colleagues, and I'll give an example. So when M-Pesa started, we have revolutionized over time, right? We do not just have a payment platform, we now have financial services, and all of them sort of have an open banking angle. So the banks, for instance, are able to use our aggregated tills, our pay bills to serve their customers, and that has opened or democratized the data. And we still haven't lost. So I think it's a mindset issue and a spirit issue. What is the spirit behind doing open banking? It is allowing financial inclusion to happen. It is allowing us to be able to make better credit decisions. So for instance, with some of my partners who are actually here, even though I am not a digital lender, I leverage on the platform that I have to be able to offer credit solutions, which I cannot do alone, neither can the banks that are offering them do without me. So the banks then help to play to their strength, which is the risk management from a credit perspective, but then I leverage on platform and customers that I have on the platform that would otherwise not be able to access credit if they went straight to the bank, because then I'm able to have more insights through the data to give them loans from nano loans and graduate them, whether they're individuals or small merchants who then are able to progress their businesses. So open banking, we are doing it in some aspects. I think it's just a perspective of trusting that there are areas of mutual synergy for both partners for the betterment of our customers.
I think it was really excellent to hear basically the convergence platform, the banking, and from an analytics perspective, what is the value that we're bringing. One question for all of you is, there is data, there's the traditional data, alternative data, the real-time data and everything. The data keeps growing basically. We're talking about data lakes, we're talking about big data. How do you see that evolving? Is there an end to that one? Is there a constant hunger, basically we want more and more? Or is there a certain cutoff saying that after this point, the marginal benefit that we're getting is not sufficiently significant? What are your thoughts? What is your views on that?
I think data is king, because when you look at the customers through the various generations, their needs are very different. What is the need of a boomer is not the same as a millennial or a Gen Z or a Gen Alpha for that matter. So without data, then how do you ensure that you are creating products for your customers and not creating products to push to your customers?
Sure.
And data cannot cease, because the moment it ceases, then it curtails the hyper-personalization process that is key in product development today. It is through that then you're able to, if it's a credit card for a financial institution, be able to know that Lucy shops XYZ, and based on that, I can give her cash back XYZ. Also, it allows us to be intuitive in our lending, which is critical. So I'll give you an example. When we started Fuliza, it was just a simple overdraft facility. What it has then translated to for the people of Kenya is financial dignity, such that if I walk into a supermarket and I do not have money to do my shopping, Fuliza will enable me to still complete the transaction without the shame of having to take the things back to the shelf or having to say, oh, I don't have enough money. And nobody has to know, because it's intuitive, it's on your phone, right? You're able to do that. The same thing for the merchant. If that day there's a good price for stocks, they can simply go to their Fuliza from Biashara and be able to got the money and they don't have to put paperwork together and go to the bank and maybe be told your cash flows today don't look so good. So it gives dignity and it gives empowerment to the entrepreneur. So data then is what enables us to do the hyper-personalization and also continue improving our product development.
I agree with that. I think the initial reaction to more data is there's no getting away from it. It's no longer a buzzword like, oh, cool, big data. It's the reality. And if you've seen how anything works nowadays, you either go with it, and if you're against it, you're generally missing out. Now, the issue that then comes with new data and ways that data is gathered is typically fear. So the moment you find that a platform is taking data from you and you don't understand why it's doing that, you have fear. If you woke up tomorrow and your WhatsApp was upside down and changed, you're uneasy for the first 2 or 3 hours of using WhatsApp until it's fixed, right? I think that can be shared across a variety of different platforms. The way to mitigate fear then is trust and privacy. And I believe it begins at the platform level that's collecting the data. The first layer being the users and developers of that platform. Do they have a full understanding of why that additional data is being collected, right? Because at some point they will also be end users of that. Once they understand the power of that platform and why it's being collected, you've got to give customer education. If customers can always warm up to understand what the benefits are of collecting this additional data, they'll be more open to using it, and that drives trust. There's an element of, I suppose, privacy and regulation, which we'll probably get to in more detail in a moment. But I think for my initial reaction is remove that fear, create the boundaries of why we have to do this.
I agree, but I'll attack it in a slightly different angle. At least in the region where we operate, you could split lending into traditional bank lending and lending outside of banks. And in neither space do you have approval rates for loans above, say, 50%. Right? So even within banks, when you assume banks you probably have the best credit profiles built through transactional records, payment behavior, really, really good quality behavioral data backed up by credit bureaus. Actual loans given to customers within any bank still fall below 50%. You still have a large set of customers who are probably not borrowing, do not have access because they don't meet certain thresholds. The approval rate, I believe, is lower outside the banking system. Do we need more data? Will there be a stop? Going back to your original question, I don't think so, because if you're leaving out upwards of 50% of the population from lending, because their probabilities of default are very high. Now, probability of default of 60% does not mean that whole cohort is bad. It just means we cannot identify the 40 good. So until we can and push those rates to levels that just look a little more decent, the industry will continue to consume data, and it will become a matter of how we share it, how we source it, privacy around it, and all, and everything else is discussed.
Very, very relevant point. So I want to basically highlight the points that we discussed, especially the keywords. We talked about intuitive, the process being intuitive. And Lucy mentioned personalization is another concept, basically. That's, again, future-related topics. Understanding the power of the platform and you use that one to drive trust is another concept that everybody is driving towards. And finally, looking at your risk appetite, what is the probability of default? What is the default levels that you're comfortable with as an institution? Those are basically areas that organizations are honing in, and these are the discussion topics. Before I move to the next pillar, everybody's nice and cozy in their blankets and all that. Let me make you a little bit uncomfortable. Do you have any questions? Do you have any comments? Anything to add? Do you want me to pick people from the audience? Everybody's okay? Any questions? I can't actually see it looking into the light over here.
Burak, can I ask you a question?
Fire away, John.
Well, the main question is, where's the fire?
There's a fire over there.
I was going to ask you about what Kamau thoughts about data. I was going to ask about what the panel's view was on data ownership. Who owns the data? Because we heard through some of the presentations people referring to, certainly from bureaus, sort of referring to we own the data. But who do you believe owns the data? I'd be interested to get your views on that.
I think you will be in the middle of the fire for asking a question like that.
The customer. That's why I believe that it is not right to share or to give services when the customer has not opted in. So giving the customer the option to opt in to a service, to a product, to a promotion is essential. And back home, I think one of the best things that came out in the recent past is the Data Protection Act, because then it enforces that. It allows the consumer to have a say in how their data is used and where it's used and by whom it's used. So for instance, even with the partnership with the banks, they can only access the product's information of the customer when the customer opts in. That is mandatory, but those are my views. Yeah. Let me hear from the banker.
No. I think we're in full agreement. And yeah, the customer does own the data. And we operate as a bank in quite a number of regions. And the key always remains, 100% aligning with local regulations, which you'll find are mostly GDPR based. Yeah, and as a result, then it's the question of ownership of data, I think, has been explained very well by Lucy. But what becomes an even bigger problem is then what we do with it and our level of responsibility as we process this data and use it to offer, all the innovative products that we do to customers. And of course, that's an evolving space. The laws, like in Kenya, were brought up just a few years ago, and the Office of the Data Protection, I think it's called ODP or ODCP or something like that. It came up with a reporting mechanism, and for at inception, about 54% of complaints by customers were related to digital lending. That has, of course, gone down. Yeah, so I think key, even besides theoretical questions around ownership and all, is just ensuring that we align with this, we respect the rights of the data subject, and whether it's banks, telcos, or others, remember that just because you're holding certain elements of data doesn't mean that you're free to do whatever you want to do with them.
Thank you. Anything you would like to add?
I fully agree, I think, with both those comments. Yeah, nothing to add.
Perfect. Any other questions? Okay, I see Karen moving. I'm just blinded by the lights.
All right, thank you so much. I think you indicated that now, in line with the regulations, you've put in mechanisms to ensure that the customer opts in or consents to their data being utilized or shared. And I've noticed on a number of platforms, most of the time, as a user, probably you just accept because you want to consume a certain service at that point in time. So I was just wondering, as the M-Pesa, if you've taken any deliberate measures or initiatives to educate your consumers so that they really know what is going to happen with their data or how their data is actually going to be used, and not them just ticking a box for the sake of consuming a service. Thank you.
Yes, absolutely. So several things. One, you're right, you put it in the TNCs in small print, customers just tick yes, right, and it goes through. One of the things, again, that the regulator in Kenya has put in place is declaration of total cost of credit. So if you go into all our products, even though it's captured in the fine print of the TNCs, you get a summary, whether it's on the USSD journey or on the app, on your total cost of credit. So the terms are very clear on what you're getting yourself into. We believe that is important because not all of us are going to read the TNCs. From a customer care perspective, we've put our FAQs and our TNCs on our website, meaning even if the customer clicked, they can still go back to the website and refer to the terms and conditions for the product. We also have utilized, and I know Burak will come to it later, AI to create an interactive tool we call Kazuri for customers, where they can ask questions regarding the products that they're taking. So if you go in there, you'll see, you can go in and say, what is Fuliza? And they will explain how much does it cost me. So it's very interactive because it's AI enabled to allow the customers to be able to do that. In addition to the customer sessions, like last week I just came from one of the regions in the western side of the country, just meeting different customers to just tell them about the product, to ensure that the collateral is available in the shops. So if they have any questions, at least they have a point of reference, because I believe the onus is on us. If you look at some of our rural populations, they're really not well versed with even the regulation or well versed with what a TNC is. So it's up to us to reach out to those areas and speak to them.
Thank you. That's very clear. Any other questions? That's very good. Okay, and the fact that Karen is not throwing any sharp objects my direction tells me that we're doing okay time-wise. So I'll move on to analytics, basically. On the analytics side, there is advanced analytics, and the advanced analytics is constantly advancing. So the concept of advanced analytics, how is that impacting credit risk management process?
Yeah, I'm happy to go first. So I was at a recent conference where, obviously responsible AI was a significant topic. And, a survey had been done at some point in time, and the statistics were actually remarkable. I think as we continue to consume more data, we found that 65% of companies that have implemented some form of artificial intelligence related model do not have the explainability of some parts of that model. What was more shocking is that over 70% of these same organizations didn't really have executive buy-in for any form of prioritization around AI ethics. And close to 80% of these further didn't have any AI ethics board. Now, the concern with that is, and it goes back to the whole fear trust to the consumer level, but at the same time, when an analytic is built out, any form of model needs to have at least 3 pillars, and from a FICO perspective, we sort of recommend at least these to be considered. The first being explainability. So any characteristic that is used within a model needs to be easily explained to a customer by the lender. The lender themselves need to understand it and explain it to themselves and their board, right? So explainability becomes critical. Secondly, it needs to be transparent, right? So how did you get to that outcome, right? Is it by use of data that was consented to and opted in? Does the customer understand that that data was used in terms of making a decision about their welfare, their life, their credit? And lastly, it needs to be palatable, which basically means is the outcome that you're giving the customer based on a characteristic makes sense for many different groups of people. Yeah. It can't be a statistic like you wore a yellow shirt when you applied for the loan, so you're getting a higher interest rate, right? So palatable, explainable, and transparent, I think those are critically important as you look to utilize any AI in terms of how your analytic is developed. If you cover those 3 aspects, you will find that it will be a lot easier to actually take your analytic live and actually get value from it, yeah? Because you don't want a situation where you have garbage in and garbage out at the same time.
Right. I agree with that, and I think Josh, you can just understand the viewpoint of someone sitting in say a financial institution, and you have a board that's pushing, and probably board members reading the newspaper every day and hearing about AI, and the question then will be, why aren't we applying it? And there's a chance that there was a rush right at the beginning to quickly develop use cases that probably did not meet the criteria you're talking about, and bad models built, and the examples are out there. We won't mention that, but there will be, and I believe there will be, a continuous move towards the advancement of the methodologies, of the technologies that we use to lend. But it does not mean that we have to rush, absolutely right from the start. My belief is AI is important, can come in supporting traditional, machine learning methodologies, for example, probably making, or rather partnering with these methodologies to make the output of these models a little more explainable, or helping banks and lenders run some other kind of models. For example, determining how to package a product for a customer rather than just whether these customers will default. So basically begin to build use cases using advanced methodologies that are probably not immediately directly credit as you slowly ease into adopting advanced technologies in lending.
Yeah. So Burak, for me, I won't go into detail because I believe Josh and Philip have covered it really well. I just want to give a challenge because I've had a few moments to sit with some and with some of the people in the audience today. Last year, we made a commitment as Safaricom that we were not going to talk about AI if we did not understand it. Because if you speak from a theoretical perspective, then you will, like Philip is saying, imagine a lot of things of what AI can or cannot do, which may be true or not. And also AI requires a lot of responsiveness, like Josh was saying. So what did we do? We decided that everyone in Safaricom will be AI certified. Seemed like a tall order. We put a deadline of July, and I can tell you right now as we sit, every single person in senior leadership and below in Safaricom has an AI certification. The courses were hard, but at least now, when we go into those meetings and talk about AI, everyone has an appreciation. So I think that's a good place to start for us to understand. The same way, I think those of you of my generation from Kenya, when you finished and you had to do those ICDL courses to understand computers, it's the same thing, right? So it's the same thing with AI. And then also having an AI champion has really helped us, someone that holds us accountable for responsible AI to make sure that we do not breach the gaps and that there's no bias in our data. That's my challenge to everyone here.
I think excellent examples, very, very good, experience to share basically from Lucy on the AI side. This AI challenge, if you don't understand it, you don't implement it basically, and make sure that everybody gets that, or everybody at the senior level gets that. It's quite a bit of a challenge, and it's really great to see that everybody lived up to that one. So good to hear. Going back to Philip's comment about not rushing about it, again, it's pretty much in line basically, do not rush if you don't understand it. And finally, going back to Josh's point on the 3 pillars, explainability, transparency, and having being palatable is, again, fundamental concept in applying machine learning into your credit decisioning, credit risk management processes. Before, again, moving to the next subject, any questions from the audience? Anything you would like to add? Certainly not a lot of analysts in the audience, that's for sure. I'm thinking there's no questions or comments, right? Yeah, I mean, it's kind of ironic to do this one, but obviously there's nothing in the horizon, that's for sure. So, I'm moving on to the next subject. Everybody ready? Yeah. All right. Technology side, and over here it is AI basically again, as you mentioned. But I think we're going to talk about how you guys are using AI on Safaricom. That would be very interesting to hear on that one. How is it? How are organizations? How are you seeing? How are you doing utilizing AI in transforming the process?
Yeah, so for us, we've had use cases like Philip defined. We had to make use cases because you start small, and then we are an agile organization. So we utilize full agile methodology in everything we execute. We have sprints, and we follow sprint methodology, have an MVP for everything that we do, including product development. So we had a few use cases across the different products, and this was basically guided by feedback from customers. So that's the direction we chose to go. We collated the feedback that had come in from our agents, from our shops in the region, and also via the care center, and then use those to form use cases to help improve the propositions or the solutions that we have for our customers. And so that has been the guiding principle. Why we felt that was important, and Philip and I are having this discussion earlier, is a lot of the AI models that come from the West are very biased towards a different population. So we have to build a lot of our models afresh for the African Kenyan population that we are serving, or the Ethiopia population that we are serving. And they have their own nuisances, they're different in why they borrow, they have their own cultural beliefs. So if you think about embedded finance, for instance, in Kenya, it will be very unacceptable to put funeral insurance to a product, but I know in the South, based on my previous role working in this region, funeral insurance is very popular, for instance. So it's just understanding those, and then when I spoke about hyper-personalization, basing it based on that and addressing the customer pain points. So as I said earlier, one of the things we implemented is Kazuri, because our customers would say, guys from Kenya, I see you that you call the contact center, you're in the queue for a long time. So what can help you in the meantime to be able to address that? Number two is then also when we spoke about people who, the 60% that we're not able to lend to, what are we not seeing? So when people call the contact center, because that's my biggest demand driver, I don't have a limit. Why do I not have a limit on Fuliza? Why do I not have a limit on the merchant term loan? So we're using then those insights, using AI and machine learning to try and dig deeper into this customer and understand, do we graduate the credit? Do maybe the OD doesn't work, they want an OD, how do we then transfer them to a term loan? So those insights are making sure that we are the right partner for our customer. The payment space, utilizing that on the GSM side, maybe Jack is comfortable buying 1,000 shillings of airtime, but Kamau there can only afford 50 shillings, right? So
too much.
Yes. How do I make sure then that I customize an offer for Kamau for 50 shillings to make sure that he's also staying connected all the time, because connectivity is a big deal. We're also using AI from a technology front. So some of our machines, we used to service them and go up there, send people up. We're no longer doing that. We're utilizing AI and machine learning to watch on our sites, to be able to know when they need to be serviced. And this has actually been a cost saving for us. So we're utilizing it in different ways. And we're just on the learning phase, but we've seen initially the benefits of it.
Fantastic examples again. Anything you would like to add, our other panelists?
Yeah, probably what I would add is in the area that we see this moving into. So of course, there are use cases around improving the customer experience. That includes communication with the customer, at whichever meeting points. There's also attempting to utilize AI in, or rather the use cases around attempting to utilize AI to determine, using as many data points as possible, exactly how to tailor a product for customers. Not to determine whether they qualify from a credit risk perspective, which we are a little cautious with. It's an incremental approach, but trying to predict other factors. How exactly should I package or tailor this product for a certain segment or an individual customer as well? Within the banking sector, there'll be, of course, many use cases, and that has begun to be rolled out around fraud management. Figuring out how to use big data / AI in moving a lot of what we do in management of fraud from a reactive to a proactive / preventive approach. So that's going on as well. When you come back home to actual credit risk management, then there are use cases coming up, not to actually build the models, but to assist the engineers and data scientists who build these models to identify the fastest path, or to highlight features that can be used in these models. But eventually, for now, actually roll out the final model using more traditional, though advanced methodologies. I think it's a stepwise approach.
Yeah, absolutely, absolutely. I mean, one experience, one comment I can share with you is basically, I'm considerably older than everybody else over here, basically. I have seen this evolution in person, the traditional business model for the banks and financial institutions was always in talk, you are all for the customer. Customer is at the center of things. But if you were to look at the structure, there's the core banking system, there's the finance system, there's the marketing, and so on and so forth. After the COVID, what is happening with the digitalization is, I mean, not even after COVID, even beforehand, there's really customer at the center, and all the different business functions are built around that one with customer in mind. What I hear from our panelists is basically, this process is staying and it's getting more sophisticated. Everything is becoming more surgical. There's, Lucy keeps using one term over here, hyper-customization, basically. This is what's happening. It is done using artificial intelligence. It is done using machine learning, but it is not done blindly. You just don't follow the trends. You really understand the implications. You really understand what it means, how it's done, from senior level to the subject matter expert, and then you execute it. I think, talking about the future, this is, I think, the steps institutions are taking to be ready for the future in the digital lending process. Yeah. So, me stopping the lecture mode over here, I'll turn it over to you again. And any questions, any comments on that one? If there's no questions, I am really going to start picking people up, just to let you know. Okay, all right. Somebody's trying to say.
Thank you. It's a very, very insightful discussion this evening.
Yes.
Since the discussion began around the AI, I think we've seen benefits. Maybe the question that could come through is, are there biases that we need to watch out for in the adoption of AI? And the next question is about, I know the banking system in Kenya is overly regulated, and as the industry makes strides in adoption of technology, in product design, where's the place of the regulator? Is the regulator equally making the same strides so that it doesn't stifle the market? So the question is, are we moving together with the regulator at the same pace?
Yeah.
And also whether there are any biases with the adoption of AI?
Should we start with the first part on the AI side, on the bias side? If you're not feeling comfortable, we can start with the other question. I have no problem. Could we get the mic going, please?
Thanks, Burak. So I think what's critically important when it comes to bias, it goes back to the whole explainable and ethical and responsible artificial intelligence, right? But I think the comment that you made around regulation, I think, is more critical, because what regulation's been for a long time is a set of rules that's been put in place almost unfairly, if depending on which side of the regulation you sit in terms of what you're trying to execute. And what that then means is you almost build your solution around satisfying the minimum requirements of regulation. And what really needs to happen, evolve, and like a conference that you are at this week, which is critically important, is regulation needs to move in line with what's really happening in the industry. So if there's something that needs to come in that requires more data, and that data is unregulated, regulation needs to be adjusted for that accordingly. Yeah, and you'll find in the Kenyan market, when mobile lending really came in, initially there wasn't a massive reaction. We continued reporting in the same way until you decided that, well, we need more information to understand these customers better, because using an inquiry-based sort of scoring methodology might impact that type of customer because they're applying for loans every single day, right? So you've got to adjust the way you think about it, but regulation also had to come into play. As more data and customers not opting in for certain activities came in, GDPR came in, or POPIA, or any of the other regulations that protects personal information. What really needs to then move forward is working together with the regulator to say, well, this is the idea of what we want to do. This is the use case. This is how AI will benefit this part of the market. A part of the market we maybe haven't seen before. We haven't lent to. They're in the 50% that we, are very high PDs. We don't understand them enough. Having this additional data will help us drive forward. And as soon as we start having those open conversations, right, looking at it from a continent, from a global perspective, what are other markets doing on the same use cases? I can tell you now, in the South African context, BNPL is growing. And you're finding that it's much easier to buy things that you traditionally use credit cards for just by taking a simple BNPL loan. But what are we doing from a regulation in terms of how that's reported? What data is gathered? What can we use additionally to enhance the modeling around that to ensure the AI solution is better? So for me, hand in glove, regulation shouldn't just be a thorn in your side or something that you have to abide by. It should be the basis in which you set your ethical model around, so that such that you do the better good for the people themselves, but also for your business.
I could comment as well. Probably starting with the first question, just to touch on it a little bit. It takes me back, I think, Burak, you mentioned that you've been in the industry longer than everyone here, but I met a gentleman who was in banking in the 80s, and 90s, and one of the things he said was, there's so much talk about AI. Every vendor is packaging their product as AI enabled or AI driven, and he says clearly, it makes him recall the 80s when the buzzword was in Monte Carlo simulation, and everyone was claiming their products or their data-driven products were using Monte Carlo simulation. So I think it's about, again, just as was mentioned earlier, and especially by Josh, just being cautious as we adopt this technology, sticking to a set of principles, eliminating bias. I'm told, I was not in the industry, but in the early days of use of logistic regression and predictive analytics, some people would build models over weeks, and when it comes to explaining them, they discover that all they managed to do was split men and women, genders. So it happens, and I think it's just ensuring as we adopt the technologies, we are cautious, we continue to challenge them, and ensure they're fit for purpose. Going into regulation, I think it's been covered, but again, and I think Kenya was mentioned, we're quite heavily regulated as banks, probably more so than the other countries in the region, the other 7 or so countries that we operate in. But we don't take that as a negative. The advantage that we've seen with the regulators nowadays is that they're willing to listen. They're willing to take up ideas from banks. They do not stop industry, either directly with a single bank or through industry caucuses. They don't stop, or rather they do not refuse to listen to what banks have to say. And we've seen quite a number of times regulators are moving in that direction and actually going out and asking players in the industry for input into a white paper or requests for comments, so, which more often than not in a couple of years turn into new regulations to support growth and innovation in the industry. And I'm not just saying that because there could be my regulators could be here. I only arrived today, so I have no idea. Thanks.
Yeah, I think I'll speak to the data bias because the regulatory piece is covered and the opportunities for us. I remember when they started registering digital lenders and the role that the FinTech Association had to play, the Kenya bankers, and just going to the regulator and sitting in the sandbox and be willing to explain and explain and explain until the regulation then is influenced to change to support it. So I think it's something we can continue to do even with these emerging technologies. In terms of bias, I think the biggest challenge is data. The output is as good as the data we feed into it. If we feed out just a small set of data, then the output that's going to come out of it. For instance, earlier we were discussing the Kenyan counterparts, how the male man, they're laughing, yeah, the male guys, the male gender gets more loans than the women, right? But the biasness is, what's the cause of the biasness? Probably because of how our scoring metrics are skewed, right? Then look who's employed, how many months of your salary do we get? Maybe the women are not as many as in employment. So if you take, the guilty ones are laughing, they know themselves. So if you take a sample of 1,000 customers, obviously, if we're already lending only to 40%, what happens? I think the benefit I have, which is on our biggest consumer product, we've got 7.7 million customers active month on month. So I do have a huge data set that is able to give me output, but I don't think a lot of us have that. So where is the opportunity? It's for us to come, collaborate together through the various groups that we have, such as the one that has gathered us here, and say, what are you seeing? How can we learn from it? And we do share that with the banks who are our partners. And just open it up. I think that's how everything has evolved, from just seeing who's gone ahead and then coming and learning from that and improving on the use cases that the person who's ahead of you has improved on. But definitely, if you put low data sets, it's going to be a biased outcome from the AI.
Thank you. My summary is going to be about Monte Carlo simulation. That was my graduation thesis, basically. Oh my God. From simulating basketball games to God knows what. I don't even remember that. I'll take a quick break. You both are from Kenya. How is the weather? Do you need a blanket? Seriously.
I just saw Kamau pull the blanket to himself.
I know, that's what I'm saying. Basically.
Yes, that will be helpful.
Okay. Could we, please?
Can I share a joke, Burak? You know how we're all focused on
If it's about Kamau, I'll give you my
It's not about Kamau. I have to watch out for my stakeholders. Thank you. You know how AI, we find it hard? When I'm now doing machine learning, I think it's Greek. It's one of the things I put in my hand to say machine learning. You know, when you have an analytical team that does all the machine learning models for you, but I challenge you to try it. It's a very difficult thing for me that I have chosen to challenge myself. So when my data scientists tell me, but that's the perfect model, I can actually be able to look at some attributes from a credit perspective and say, but that piece might be missing.
Nice.
Yeah, so that's the challenge I keep giving myself. I'm going to try to do as many of this, so when I do the product development piece, it makes sense to my customers.
Fantastic. That's really fantastic. Any questions? Any comments? Nothing in the horizon. Is there?
Yep.
How are we doing time-wise, by the way? We're good. That's clear guidance. That's very specific. Thank you for that.
Hi, I know one of the things that digital lending has done is enhance financial inclusion. But I think it would be important for us also to look at the financial health of the whole ecosystem. And my question is, while leveraging on technology, how can we ensure that we maintain that financial health? Because like we have seen in Kenya, where we have an issue of the regulations actually came because there was like let me call it reckless lending by using the technology as well, that is AI. But how do we ensure that we don't get into that state, and that we also make that credit sustainable to these the users of this system using technology? How do we leverage using that? Thank you.
I look forward to the day we'll have digital lenders in Kenya able to see their loans on CRB. So for me, that's my dream, because I think that's where a big black hole is at, because we can see all the lending in the banks, but you're not able to really see the digital lenders, especially with the increased size for reporting or listing guys on CRB. That has also opened, whereas it's contributing to financial inclusion. How can we still get visibility? I think there's an opportunity. That's what AI can allow us to do, but it will require concerted effort from all of us in the industry to come together and say, let's put this data somewhere. And then let's all be able to click on it or double click on it if we need to before we make a lending decision. My thoughts.
Yeah. Just going back, the regulations in Kenya came in because, as you rightly say, there was an element of reckless lending. And did the regulations assist? Of course. Regulations around data privacy requirements that lenders are registered and so on, which then created some, you could argue, some sense of some sense basically. But it has to be a mix of both. Without the regulations, of course, then you would have had lenders probably, for lack of a better word, becoming a little lazy, because I do not actually need to go in and run the best models because I will not align with data privacy best practice. I will have collected personal information of relatives and I could use this to threaten the customer to repay, to threaten to embarrass them and so on. Those regulations pretty much, I wouldn't say evened the playing field, but created an environment where we now need to get a little smarter. You're limited in, or have been forced into the straight and narrow. And as a digital lender, or even a bank as well, you now have to do a little more thinking. And thus, this technology is coming to play. Better predictive models, better data, better engineers, better data scientists, better processes, and so on. So the two then begin to become, a sense of a mix. I do not think the regulations were a bad reaction and were necessary. They actually created, in my view, an environment where customer is protected, and then we as lenders have to become a little more innovative. So I think going forward, it's a nice space. We're going to see a lot of innovation within that environment.
There's one point I would like to add to that one. As soon as I finish, it's yours. One point I would like to add to that one. The point Lucy made over here is very important. Once you have all the different data aspects available from different type of lenders, what happens is everybody's very much focused on the PD, probability to default, and so on and so forth, all the related topics. What if you were to bring a different concept over here, consumer indebtedness index type of a thing, which doesn't give you the likelihood to default, it gives you the likelihood to be over-indebted over a longer term period, basically. Then you take that one on one axis, you add the other one, probability to default, on the other axis, that opens a whole new universe, basically. But I mean, like I said, for us to do that type of analysis, it goes back to the very point Lucy has made. You need to have the overall exposure over here, and that goes back to the heart of the discussions on buy now, pay later, and so on and so forth. Is everybody really reporting that one? Is that information really available? Because at the end of the day, if I'm blind to that side, well, if I don't have that information, I will give you the credit, basically. And overall, you're probably over indebted already, and that's the biggest challenge that the whole industry is facing. What you don't know what you don't know at the end of the day. Good intentions, bad intentions, everything. But the reality is, unfortunately, you're missing that piece. Okay, I will stop, regurgitating that subject, and it's all yours.
Thank you so much, Mahauta from Sakra. And I'm sitting here as a South African, and I'm wondering, why some of these products and offerings have not been able to take up in South Africa, like your Pesas. Like, I know MTN has been sending me something about Momo, but I've never taken it up. So I'm wondering about what is unique about South Africa that some of these products are not, and offerings are not taking off. And I think on the buy now, pay later, I think as Sakra, because we are facilitating the reporting, we are struggling because we have some credit bureaus that are saying it's not credit, why should it not be reported? If you report it, you know how it's going to impact on scores. So I'm interested in that question to say, it does have value. We've gone to the regulator has said, yes, it's not credit, but it's valuable. So currently we are, they are reporting BNPL, but I think, yeah, some of them, and remember, because of the reciprocity rule, those that are accessing payment profile have to report. So you have some buy now, pay later guys who are submitting because they have to, because they are checking credit profiles. But I think, you know, you touched something on me to say we need to look at it, and not from a point of view that it's not credit, so it should not be reported. My view is that it should be reported. But I think you have sort of touched something in me that says we need to pay more attention to it and actually make sure that we can derive some value, and what are that criteria that we need to use for us to be able to advance that reporting. So thank you for that. But yeah, what's so different about South Africa? I mean, even digital lending hasn't taken off.
As a local, I'll answer some of that and maybe take part of this conversation maybe offline with you separately. But just because I don't have the official statement. But in terms of, you know, the M-Pesa mobile money, it was, when I was introduced to that in the Kenyan market in the back end of 2016, it really took the market by storm. And it was an amazing concept of having it on your mobile, USSD codes initially, and getting that, and like, why was it not working? And I think it just comes down to the fundamentals of the dynamics of the market. So South Africa is a very mature credit market. You know, it's had scores, it's had credit lending for over 30 years, or if not more. And what that comes with is a very strong banking environment, where you know, a lot of you basically got a bank account of the bank that your parents had, and they probably had the bank account of their parents, right? And you got your mortgage through there, and you probably stuck with that card until you were in your 20s, and then you either stayed with or changed your banking. So the access to credit from a banking relationship was already there. So we didn't have customers going around on mobile trying to find alternate methods to get credit, because you just got it from your bank. You need a loan, you go to your bank, you get your loan. So those were the early days, and I think it was piloted in market. It was tried by, you know, Vodacom, which Safaricom, and so on, you know, the different relationships over the years. So that's how it began. But it's changing, because it's evolved to a point now where the new generation don't have this loyalty any longer, right? No one cares about the bank of dad or bank of granddad, yeah? So you will go and get money wherever you can. It's simpler to go onto a mobile platform, buy something, take a simple BNPL loan and not pay interest for 6 weeks and buy that, rather than having to put your credit card details, which you don't have and you don't have on you because you're using Apple Pay or Samsung Pay. So what we're finding is it goes through peaks and troughs. So you've got the traditional age group, which will still go to the primary banked banks, take every single loan, mortgage, personal loan with them. And you have the newer generation who just want the credit and continuously rinse and repeat, basically. And that's why it comes back to the question on BNPL data, and I'm so glad you made that comment, because, you know, in my time, in my previous role, you know, we also talked a lot about BNPL. Is it credit, is it not credit? But we do need to understand the consumer. We do need to give a view of that consumer and a score to be able to allow that BNPL to allow additional credit. And you know, quite right, you know, some regulations need to come in terms of how it's reported. And I think it's moving in the right direction. And what we're seeing from a credit risk perspective is, from a scoring side, is we've almost gone full circle. You know, if you look at how credit scores started 25, 30 years ago in South Africa, you had your broad-based bureau score, which was a score based on all your trade lines reported to the bureau that was used to make an assessment of your risk, right? But as banks got bigger, they got their own customer bases, they built their own scoring models. Those are very specific to their customers. They still use broad-based bureau scores, but their scores provided a more predictive view of their customer. As loyalty falls off, the bank doesn't necessarily know the most about their customer, because their customer are taking a variety of different loans from different places. And that's where broad-based bureau scores come back into it, because now that gives you that overall bird's eye view from a credit bureau perspective of what can happen. But now the second part is the data quality isn't there, because what you find is BNPLs could be at times utilizing payment profile information, right, to make an assessment on credit, but not report or find the need to report on who they've given credit to. A bank doesn't see that transaction and can't adjust their risk accordingly. it's not seen as traditional credit. So it is an endless sort of cycle that started. I think it does need to be addressed, and regulation will talk to that, because it is definitely disrupting how things are done from a more transactional, ongoing basis. I hope that answers. I can help you take you through some of those
thank
things.
you. I mean, it's an issue that as SACRA we need to deal with, because we facilitate the sharing, and BNPL is like blowing out, and we need to ensure that it comes into the fold.
And it's also the variety of things you can buy with BNPL. And you'll be shocked that the same BNPL can buy you, a fridge or something else, completely. So another monster additional data is sort of where I was going with that. So you don't just want the standard trade reporting line, you also need to understand the purpose so that you can understand the customer's need at that point in time to make your hyper-personalized offer to that customer from your platform.
I have nothing to. I fully endorse that answer. That's perfectly in agreement. Any other questions? Nothing? Okay. Let's move on to the next subject, which is cybercrime. Fraud ID challenges. Are they stabilizing? Are they getting less important? Are they becoming more important and more of a nuisance, more of a significance? What are your thoughts? What are your experiences?
Lucy, this one is really picked for you.
I could hear the Kenyan music crowd laughing. Fraud is big, right? Fraud is big for a technology company like ours with 32 million customers in a 50 million population, right? So we are the wallet for the bank for 3/4 of the nation, and a lot of people get creative around money. They want to go into people's wallets. So what we've done is ensure that we have a very robust fraud management system. We have, what I'd say, some of the best fraud analysts in the industry working in Safaricom. What we've also tried to ensure is when we see patterns, we work on them really quickly and fix them. So seasonality is a big one. I don't know about the South, but seasonality, when people know it's Christmas, everybody's going to have a lot more money in their wallet because they're going to shop a little bit more. Or like next week, everyone is taking their kids back to school, so there's going to be a lot more money in the wallets. So just understanding that and doing the best. How have we helped our customers? And I think that's the most important point, because fraud will happen sometimes, despite our best efforts, is through a customer care center. You can call for reversals. If it's a P2P transaction, so a customer can call in and be able to describe the fraud that they've gone through. And I think this is an important part for us, whether we are banks or technology companies, that the customers can have the comfort of knowing that there's someone they can call if there's fraud happening. We've also are not shy to blacklist someone if you're a fraudulent line. How do we do that? We have a fraud reporting SMS. So if you can't get through, let's say to the phone call, you can quickly put in the number, and what we do is our fraud team will look, and if it's a fraudulent line, we will protect our customers. So that's really important to us, and it's really fast. Actually, it's my favorite way to report, because you just send in and someone responds immediately because it's picked up on a rolling basis. What are we doing? We're using AI to again understand the ever-changing world of fraud. We're also using machine learning to understand that. We work very closely with the regulator, because the regulator also has insights into the changing fraud environment. There's collaboration with our partners, whether it's the banks or other lenders in the industry or other P2P solution providers in the industry. We also run customer awareness. So we periodically send messages to our customer to say, this is the only number Safaricom will contact you through. This is the only number. So customers know now. They know the Safaricom number and exactly what it is. So when someone else calls, we run awareness on questions even in local languages. Some of our elderly are the most vulnerable people. So we'll say to them, if someone calls and asks this, please do not give out your personal identification details. Do not give out your M-Pesa PIN to anybody. When you walk into our shops to do a PIN change or to change a line, we ensure that we truly authenticate the person that is doing that transaction. I think another issue is we have recycled lines when people pass on, right, or they change numbers and drop lines. We have a very robust recycling process, but we're able to check and see, did Lucy have a loan? And she's dropped this line. There's interoperability in the country right now. Where has the loan gone to? How can we reach out to Lucy on the secondary line? Or has Lucy gotten a line that probably doesn't have a facility she has, and quickly be able. So our recycling process is very robust to ensure the recycled lines are well taken care of before we give them to other customers. The other thing I'll say about fraud is just internal awareness among our own staff. So our staff are our first ambassadors. If customers have an issue, they can call any of the staff members who will be able to be armed with the information to guide them how to address the fraud. Because if you have a staff force of over 2,000, that should be your first stop for it. And then we also do a lot of sponsoring of fraud awareness trainings for our agents. So for those of you not familiar with Safaricom, is the way we operate. We have our shops, but then we have agents in the villages who are dealers that we've trained and appointed. And because a lot of the M-Pesa transactions happen through those agents, we usually train them on fraud, how to detect fraud, how to report. They have a special line that they can call through to be able to assist in case they encounter fraudulent transactions. So agents are a big deal for us, because when we started M-Pesa, like the lady asked, one of the reasons we were able to penetrate heavily is our agent model. So it remains a really important part of our business.
Thank you. That's very clear. Any questions? Please.
Okay, Sakura. I can just take a seat, yeah.
Yeah, you can just take a seat. Yeah. No, I think maybe it's more of a comment, because, you know, fraud is definitely an issue, and I think here in South Africa as well, you know, providers are really taking many strides to try and prevent it. Tomorrow we will have we do have a credit bureau that deals only with fraud. So if you applied for credit using false documents, you would be listed at that bureau. So before a credit provider grants credit, they check your name against the fraud prevention service. And what they also do is that you can proactively list your identity number with the South African Fraud Prevention Service, so that if anyone, identity theft is a big thing, you can then list your ID, so that each time somebody tries to use your ID number, they check against the Fraud Prevention Service, and it's also funded by industry. So you'll see in South Africa, industry takes a lot of initiatives to try and deal with a lot of these issues. So Mani will be here tomorrow to talk about how we deal with fraud. But I think also, you know, there's also the psychology of it that I think is difficult to deal with. And some of us women who are desperate for love are being really
Okay, I take it as a cue to move on. So that's okay.
But you know, and it's, yeah, you know, for me the issue, what we've seen, because I also work in the space, things that we take for granted. You know, to apply for credit, you need your pay slip, you need your ID number, you need your proof of address, and some of us just leave these documents lying around. You know, we've seen cases where your own husband, your own partner, your own sister steals your documents and goes and opens a credit using your documents. So people must look after these things, and I suppose the psychology side of it is very difficult to deal with, because there's also greed. We've fall for some of these scams because there's a greediness part of it where people are not certain things. So yeah, I agree it's a big issue, and tomorrow we will be talking about it and some of the the mitigation factors that industry in South Africa has put in place to deal with fraud.
One comment, thank you. One comment I would make to that one is also in different parts of Africa, there are places where there is not a unique national ID number, basically.
Yeah.
So sometimes you use your national ID, sometimes you use your passport ID, sometimes you use something else, basically. It really becomes problematic to really identify who is that individual that I'm looking at. But again, that's a deeper concept, and I'm not entitled to go into much detail, at least not after 8 o'clock in the evening. So on the regulator side, I wanted to, basically the point I wanted to highlight was on the privacy and trust, but in the previous conversations we touched them, and I think Lucy gave very tangible answers to that one. So given that actually, Kamau, I'm getting cold over here, but anyway. I want to move on to the last topic, which is, on the people side. And this is a really open question for all of you. How do you vision it? How do you envision the future from a people's perspective? Let me give you an example. I mean, this has been always in my mind. I have been applying for microloans or digital loans constantly, and I'm getting 20 euros here, 30 euros there, and so on and so forth. After 5 years, 6 years, 10 years, do you see me getting enough credit to buy a refrigerator? Do you see me getting enough credit to buy a television or something more tangible, basically? How do you see that one? And this is not a trick question or something like that. It's just curiosity, basically. Am I going to be staying at the level that I am all the time? Am I going to be moving up, or is it just a function of, again, the hyper-customization concept?
I could give it a go first, and I assume you're picking this up from digital lending perspective.
Yes, absolutely.
Yeah, in the back home, of course, the picture that you've put out, you've got all these digital lending products, and the tickets are relatively small. You're going into, in many of them, or in some of them, ticket sizes that average below $100. So the question then becomes, what's the future here? And the argument that comes up is, how can lenders work towards enabling these consumers or these businesses graduate? And my thinking is, there needs to an extent to be a deliberate effort. And it's multifaceted. I think there are very, very many factors at play. One is, and I don't want to go into that again, I think you've already mentioned it. As we lend, we need to lend responsibly so that the lending that we are undertaking is actually used to grow our consumers or our businesses and so on. We need to invest in whether it's technologies or frameworks to ensure that we are not overly indexing these companies. I think you mentioned an indebtedness index. In our own analysis, we have begun to measure what we call time to default. Just exactly how long, because you cannot. It used to be a joy seeing a customer borrowing every month. Today we actually see a customer borrowing every month, and you begin to think, are they borrowing to repay the other lender than borrowing, basically bouncing money around. We need to figure out exactly how, as industry, as lenders, to avoid this problem, because that becomes a first stage in ensuring that the lending where our lending operations, the money we are putting out there, the capital that we're putting at risk, is actually being used by these businesses or people to grow. Now, then what next? It's unfair to suggest that if you're lending to a micro, you're going to continue to lend to them, say, for a 1-month loan for the rest of their lives. We need to begin deliberately to figure out exactly how, and whether it's data points that we need or conversations around customers, we need to figure out how then to transition that customer into 3 months, 6 months, larger amounts. If it's a very small business, trying to figure out how do we transition them from working capital to larger working capital to actual investments, whether it's in machinery and others. And banks like us are beginning to take that deliberate effort. There's the flip side. You'll find many lenders, and especially in jurisdictions that are regulated, would probably prefer to stick to that 1-month loan. It makes some sense in the short term mathematically, because you're probably charging what, 7-8%. Take up my loan for 1 month, I get 8%. Take another one next month. But is it sustainable? So that element of sustainability becomes key. If I graduate you over time, I should actually envision a situation where if you're a consumer, I have a large mortgage and transfix this, because the alternative is a customer who continues to borrow that 1 month loan and then defaults 2 years down the line. So my point is, we actually, as lenders, have to make a deliberate effort to figure it out from a data perspective, from a customer experience perspective, figure out exactly how, over time, to transition these customers into long-term borrowers, into bigger borrowers, and actually think about a sustainable model that will keep us in business over time.
Yeah, and I'd like to tap into that conversation a bit more. So I think that the major question is, what is actual true financial inclusion? Because that is a debatable term, and I think if we position efforts once you have the customer on board and have access to all this data, the customer education piece becomes so critically important at that point. If a customer is continuously borrowing 1 month loans, are you happy that you financially include that customer by giving them credit and they've taken as credit ongoing and you're making money and the business is happy? That's one aspect. The other aspect is the customer's given you their data. You've hyper-personalized the amount potentially of what they need. Give them more, right? Use your platform, use the big AI technology to drive that education further. Simple questions. What do you want to do in 5 years? Do you want to buy a refrigerator? Do you have a savings goal together with your credit? Because credit, and I always debate this topic, because when it comes to financial inclusion at an 18-year-old, someone's coming out of school, getting ready to go to university, is the first product that they should get something credit related? Or should they have a quick course on how should you go about obtaining credit for the right reasons? Right? Because what generally happens is, if you approach this too aggressively, too quickly, and you provide this 1 month loan potentially to a student, once they've defaulted, you're not going to touch them for 3 to 5 years. And that's going to sit in their profile until in their early 30s. Then they need a mortgage. And you're trying to start to develop some form of credit history utilizing the data you have. So I guess the challenging on top of that question would be, what are you doing enough from a financial inclusion perspective to not only grant credit, but to educate your customer? And I think that's where we all can be better for the continent, for the industry, because we have a lot to learn in Africa and we want to learn, and we're learning at a rapid rate. So the idea is, how do you create that awareness? What is the score? Do you understand what you need to do to improve your score? Do you realize you've taken 6 loans in the last 6 months? Did you need to take 6? Can you try to get 5 in the next 6 months, but maybe at a higher limit? Do you have a savings goal? Can we offer you something side by side from a big banking perspective? Can we offer you a savings pocket together with the credit? So even if you're saving 10% of the credit you've taken out, and yes, you're paying fees and all of that, it sort of gets you into that mindset of, well, there's more to than just using this for my day-to-day. I've got bigger aspects and prospects to do that. That's my view.
I completely agree. Interestingly, my 2 portfolios that have a saving component perform the best. When I go to the market and I ask customers, which of my products do you like the most? Those come out without a fail. And you say something powerful, because when you asked the question, Burak, I just kept thinking, we've really thrown around financial inclusion around as a buzzword. But what is it really? Financial inclusion is purpose-led. Just said to us earlier, the reason South Africa is where it is with digital lending is because people would go to the bank, the banker would know I've started college, they would know my ambition is to get a car, they would know, do we understand the purpose of funds for which our customers are borrowing? Why is it that entrepreneurship doesn't thrive a lot in Africa, except for South Africa? You're very fortunate to have the Black Empowerment Fund. I prayed some of our markets would have that. But in the other markets, where you've got a lot of micro merchants, why is it that it's not growing as fast as we know that it needs to grow. It's very simple. We're not tracking the use of funds. And so I've been very deliberate in the new products I'm launching to track use of funds. So I'll give an example. My typical merchant is the lady who sells vegetables out there, right? She's in an estate, she's selling vegetables. In Swahili, we call them mama mboga, the vegetable lady. So my mama mboga will obviously be buying her vegetables from somewhere. So through data, I can see how much she borrows, how long it takes her to use those funds, and when she repays back based on the tenure of the facility that she has taken. If it's an overdraft, how quickly she's able to pay. If it's a term loan, does she use the entire tenure of the facility? Number two, when I go for my market visit and I interact with this customer, through my interactions, I can figure out what's her dream. Maybe she wants to move from the shed to opening the shop in the stall in the market. Then it's up to me to figure out this particular customer. And most of them, I don't know, in Kenya they usually have associations. So you have like Joakali Association, the Hawkers Association, the Shoe Shiners Association. So you're leveraging on economies of scale because you have the data. And understanding, okay, so this guy's next thing is he doesn't want to just polish the shoes at the bus stop. He wants to now be part of the guys that have a stand. Whether it's the Mama Mboga wants to go to the stall. What does that mean? And I remember I had this conversation with a partner when we were discussing limits and NPL appetite, credit risk appetite. And we had a limit discussion and I asked, how much does it cost to buy a lorry of potatoes from the market? If your Mama Mboga is selling potatoes and you don't know how much a pickup of potatoes is, then you have no business being in credit. Because then what's going to happen is you're going to give them money as a merchant, but they're going to use it for their consumer needs, and you'll never help their business for financial inclusion. But if I know she takes 2 sacks of potatoes, she sells that in a week, then I know that she needs a 7-day term loan and not a 30-day term loan. Because then that 7-day term loan allows her to come back the next week and buy the next stock. So that's how we need to look at our customers. And now we are privileged to have the data and AI and machine learning in our organizations to give us that level of depth. So one of the things I track religiously is use of funds. If you come into any of my portfolios, I can be able to tell you this money that they took for the loan, X went to pay for stock, because I can see where the money went, or X was used to do something else. Because we also have focus group for customers, right? Even where you don't have AI capability, we can call customers for focus groups, right? And just find out what they want to do. So that's how we leverage on the insights from our customer, capture the voice of the customer, and also use data to understand really what is this business about and why am I financing. If it's the consumer, it's a lot easier. Responsible lending. We're trying to do BNPL in Kenya. I must say you guys are way ahead of us and we are always referencing South Africa for it. But I think the BNPL in South Africa is a perfect case of financial inclusion through purpose-led lending. Because the person is getting money for the fridge and they actually get the fridge, right? The person is getting money for the TV and they get the TV. They won't be able to take the money and use it for something else. And maybe that's why you guys have been so successful. And maybe that's why it's overtaking the credit card, like you mentioned. So for me, I think that's what is important, that for us to empower the businesses and speak to what they probably are telling us, but we're not listening to.
Thank you. Any questions? Oh, no, there's no questions. Okay, shall we move on?
You know, it's August and it's Women's Month, and I'm so proud that a woman is sitting there and really talking about what real financial inclusion is. Because I think a lot of credit providers are running a sausage machine. with very set criteria of how they will learn. No one is really willing to invest the time and energy to do what you are doing, to understand that woman who's sitting in a corner selling amakwenya. They just want to input and say no thank you. So I think you are touching on, for me, a very sensitive issue to say, get to know your customer. Because a lot of them are running a sausage machine. I am privileged to have a private banker. So I have formal employment, and I'm also a businesswoman. I have my side hustles, So if I go to my private banker and say, because I also do catering on the side on weekends, the minute I say I need money for my catering, it's like, I know. She doesn't even ask me, how are you doing it? What's happening? And then I say, I want a 1 million rand Mercedes Benz. Bona.
Table.
Same time. Table diesel. And I'm like, hey, and it's sad because we talk about financial inclusion. What is it? Is it throwing a Mercedes-Benz line at me, or is it really understanding, the character of my business? I also do a lot of work in the mining sector, where, a lot of lending is done to mine workers. And when they do the affordability assessment, it's like most mine workers are migrants. They live in compounds that are provided by the mines. And when they ask them, do you have transport costs? The mine worker would say no, because I work from the compound, I go from the compound to the mine. But the credit provider doesn't care to ask that you have a family in Lesotho, you have a family in Tanzania. When you really check and understand, this person is spending 4,000 rand a month to go home and to advance money to the family that is remotely somewhere. So I think we really need to search within ourselves, and I think we've said it, you've said it, that we love throwing terms. If you can say AI, this person is on it, financial inclusion. But people are not doing the real work. It is expensive, it is time consuming. And I've traveled in Africa, and I think you guys are doing it better than us. Because and the other thing that is, because I've also dealt with stokvels. If you know, in South Africa, stokvels are group savings schemes which are very big. And the financial services sector has not been able to capture stokvels. Why? Because they've never cared to understand how stokvels work. For example, you have stokvels that collect, that also provide funeral cover. And you would advise them and say, you need an underwriter. And they would say, no, we know that you need an underwriter, but we are not going to use an underwriter because the underwriter wants us to discriminate, and exclude certain age groups. So here it's a top-down approach. This is a product, you take it. I also belong to a stokvel. And the bank said to us, in order to open a stokvel account, 3 of us have to go to the bank. And we are executive women, we are busy. And within our schedules, we couldn't make it to go and open physically, sign. Hypo. So we don't have a stokvel account at the bank. So I think, you are raising very important issues to say, let us not throw these things around, because for me, proper financial inclusion is not throwing just any product that you think is suitable for that person. It's obviously it's going to the ground, understanding the person, understanding that they need money for stock to go and buy flour and yeast 8 o'clock. By 12 o'clock, they have sold 100 magwinyas and they can pay you same day. Better than Mahauta who has a salary. So can we please do the right thing when we say financial inclusion? Thank you.
Understand. Thank you very much for the comments. Any other questions, comments? I looked at the light so much, I see stars basically. So, in bringing it to conclusion, basically, I just wanted to thank you for your participation, active participation, which is very much appreciated. When I look at my panelists, you know, Lucy, thank you very much, Josh, and Philip, thank you very much for helping us visualize, helping us feel the issues and the solutions that you're bringing to address those issues. Thank you very much for taking our, you know, abstract context and just basically making it something that we can touch, feel, and understand. And Philip, thank you very much for keeping us real, basically, you know, staying to the ground. Yes, there's all kinds of fantastic concepts out there, but the reality is over here. Yes, eventually we will get there, but it's going to be a step-by-step process. So with that, I would like to thank everybody, particularly for our panelists, for sharing their insights, sharing their experiences. And this has been a fantastic experience for me. I have learned a lot. I have learned a lot from yourselves as well. So thank you very much. And this kind of concludes our fireside chat.